left hook. When a financial crash hits, most people panic, politicians scramble, and markets burn. But what if the real winners are the ones standing quietly behind the smoke? Crashes look like chaos, but history reveals a pattern. Every collapse pushes global power upward, not outward. The biggest institutions never fall during crises. They grow, setting the stage. To understand why, we need to examine the architecture of modern finance. Governments rely on money. Central banks create it. Global financial institutions move it. But behind them exists a shadow layer that becomes active only when disaster strikes. In every major crash, these hidden players emerge stronger. This isn't coincidence. It's design. Origins. The strategy began early in the 20th century. Wars created debt. Debt created dependence. Central banks gained authority by stabilizing economies. Each crisis expanded their influence. Every bailout increased their control. Crises became opportunities to reshape financial power structures. Rise. By the 1970s, money itself detached from gold, removing natural limits. Loans flowed globally, especially into developing nations. Then came the interest rate shock. Countries defaulted. Institutions like the IMF stepped in with rescue packages. But these packages demanded privatization and foreign ownership. Asset transfers became standard policy. A crash became an entry point for global control. Breaking point. The 1990s and early 2000s made the pattern obvious. The Asian financial crisis followed predictable steps. Capital fled. Currencies collapsed, nations surrendered economic independence. Then came 2008, a meltdown caused by risky financial behavior. Yet the biggest banks weren't punished. They were rescued. They absorbed competitors. They emerged larger and more powerful than before. Fallout. Crashes should weaken reckless institutions. Instead, they remove smaller players. They eliminate competition. They justify extreme interventions. They centralize authority. Those who control liquidity decide who lives and who dies. And every crisis pushes power upward. Failed fixes, reforms after crashes always sound promising, but new regulations contain loopholes for the largest institutions. Emergency programs increase dependency on central banks. Bailouts reward risk-taking. The underlying structure remains unchanged. Crashes are treated, not prevented. Modern parallels today, global debt is at record highs. Shadow banking holds tens of trillions. Inflation destabilizes nations. Central banks influence markets with a single announcement. A handful of asset managers steer global capital flows. And each new crisis strengthens them further. The system has become self-reinforcing. 3 takeaways. First, crashes transfer power, they don't destroy it. Second, those who manage liquidity control outcomes. Third, the pattern is accelerating and becoming more coordinated. Final warning: the next major crisis will not reduce global financial power. it. It will condense it. It will tighten the hierarchy. It will shift influence into fewer hands. And by the time the public notices, the consolidation will already be complete.